Howdy, Jacob here. Today we're looking at Extreme Networks in the communications equipment industry, 2.4 billion market cap, essentially the same enterprise value. They provide software-driven networking solutions worldwide, headquartered in North Carolina, incorporated in 1996. Revenue growth over the last 10 years looks great, but it is wildly consistent. We see revenue as high as 62% year over year, but in the most recent year, dropped 15%. Gross margin, however, is up. Operating margin is having trouble staying positive. Return on invested capital, again, is kind of based on that figure. And so we do see some negative return on invested capitals here for the years that they didn't make any money. Their income statement does show some good spend on R&D. I mean, you're looking at 15 to 20% of your expenses from revenue going to, or 15 to 20% of revenue as expenses is R&D. That's going to be taking money away from today to hopefully make more in the future. Now they've been spending almost over $200 or around $200 million since 2018, and the business has done all right from a revenue growth perspective, but surprisingly not as much as I would expect, and definitely not making the company that much more efficient. Looks like it was kind of working until 2023, and then the most recent year, they dropped in revenue, and that really hit their bottom line. So their cost of goods sold and then other operating expenses, or their cost of goods sold and then their operating expenses was almost kind of fixed and really hit their bottom line when their revenue dropped. So their balance sheet shows $157 million in cash and cash equivalents, with $9 million in short-term debt, $178 million long-term debt. That's $30 million more short-term and long-term debt than cash and cash equivalents, and they make more than that in almost every year in free cash flow. So we're not concerned with that balance sheet. Their or especially the interest-bearing debt on that balance sheet. Their use of free cash flow is just debt reduction and share repurchases and some acquisitions. And so it seems like when opportunities arise, they do make acquisitions. And the bummer is that 3 of the 4 acquisitions, the larger net acquisitions that they've made of the last 10 years, they did fund it through debt, but they haven't issued any debt since 2020. And so outside of that, they have been consistently buying down that debt. Again, we're not really concerned with that debt figure, but it is good to see that they are delevering. And so again, if you find great opportunities that can give you a massive return on investment, then going into debt to fund some of those things, bearing that it's not an immense amount of your free cash flow from a percentage standpoint, can be worth it. It is a leveraged bet though, so obviously you are taking on a little bit more risk, but if you're very confident and you're very confident in the return that it's going to give you, then that can be extremely advantageous and give you as the investor a levered increase in return on invested capital, essentially. And so for right now, balance sheet perspective, rolling 12 is actually negative, but the last 4 years, 5 years, 6 years have looked pretty solid for the business. And so although it's been kind of up and down, we'll make some assumptions, or I will make some assumptions based on the averages that I've seen from a margin perspective. So from a revenue growth perspective, it's been hit kind of hard here. They are spending a good amount on R&D, so I would think that at least some of it, even if they're not entirely and crazy efficient with their research and development, some of it should be going to the top line, and especially some of it should be going to the bottom line. And so I would think that I probably wouldn't be terribly surprised if they grew at about 5% a year. With that, maybe market average with the return on invested capital, with the inconsistency of the business, I think I'm fine with that. And then for margins, this is one where I'm not entirely confident. It's kind of all over the place. Maybe I'll go 4 and 6 with, share repurchases, 1% for them is about 24 million. But their stock-based compensation is pretty high, so I don't think they're even offsetting stock-based compensation. So they are likely diluting a little bit, maybe let's say 1% dilution. And that means that the business got to fall, the price of the stock needs to fall quite a lot before you get the return I'm looking for here. And so, maybe I'm just being a little bit hesitant given the inconsistency of the business, but based on what I'm seeing, I don't feel much more confident in changing any of these. Possibly the margins are a bit low based on the historical free cash flow margin. is what I want to go after more. But the most recent year, and 2020 had some pretty rough years. I don't know if I should take 2020 entirely into effect, given that it was just a wild year and caused some fluctuations in almost every business. But the most recent year has really given me hesitation on how high I should put that. So interesting business, definitely not in the perfect realm for me, and definitely not from a price perspective looking obviously cheap at this price. Hope you enjoy the video still and have a great rest of your day.